Hey investing friends, in this video we share our $160,000 TFSA dividend growth portfolio for the month of August. We're up 3% on the month and the rally in dividend growth stocks is just beginning. Let's do this! For those new to the channel, I'm Mr. Financial. I've been investing in the equity markets for nearly 20 years and I've seen the market's ups and downs. My wife, Mrs. Financial, and I have been sharing our TFSA dividend growth portfolio for the last 2 years here on YouTube. You can follow our journey by our monthly portfolio updates along with our monthly income updates. We're also pretty active on the free investing app Blossom Social with over 35,000 followers. We feel blessed. Feel free to follow us there using the link in my description. In this update, I'll be sharing each position I hold in my TFSA, some of the important metrics on my custom slides, and what we bought in August. At the end of the video, I'll share the industry breakdown of the portfolio. Let's kick off this update with Bank of Nova Scotia. It represents 7.3% of our portfolio as the fifth largest holding we have. After the second 25 basis point interest rate drop at the end of July, banks have been on a real uptrend. Q2 earnings were out on August 27th, and they were as expected. Here's a snapshot of the metrics. Revenue is trending up, and capital ratios are improving. 51% of revenue is still coming from Canada, with its next biggest market being Mexico. And when it comes to allowance for credit losses, they are still high but stable for the past few quarters. Next, we have our fourth largest holding, TC Energy Corp, at 7.7% of our portfolio, and growing. TC Energy Corp reported earnings on August 1st. Here's some of the slides from the presentation that day. Year over year, comparable EBITDA is up 9% to $2.7 billion on the quarter. The EBITDA for 2024 estimate is coming in at 11.2 to 11.5 billion. And deleveraging efforts are going well. Yes, debt has increased, but you'll notice the debt to EBITDA ratio has been dropping and is expected to be in the 4.7 to 4.8 range by the end of the year. The next stock in our portfolio is Fortis in the utility sector. It has also benefited from the drop in interest rates. It now represents 5% of our portfolio. This is the lowest beta stock in our portfolio at 0.22. That means if the TSX composite goes up by say 1% or drops 1%, this averages 22% of that move. Or in other words, it would go up by 0.22% if it went up by 1%, or down 0.22% if the market dropped 1%. Did I confuse you? Next up is my favorite REIT, RioCan Real Estate Investment Trust. It represents 9.3% of our portfolio. The share price has really been increasing, and you'll notice that after looking at our DRIP price this month. RioCan also reported Q2 earnings on August 8th. RioCan's portfolio has been improving since the pandemic, and I'm happy to see these metrics continue to improve, such as the rent per square foot. Also, the financials are stable despite the ugly development environment in Canada. RioCan reported 43 cents of FFO and a stable 61.5% payout ratio on its distributions. We dripped 3 shares, comparable to 4 last month, at a price of $17.35. That added $3.33 to our dividend income at a yield of 6.4%. Next up is one of our telecoms, BCE Inc., representing 4.1% of our portfolio. BCE reported earnings on August 1st. Here are some of the highlights or lowlights. Revenue was basically flat at $6 billion. FCF increased 8% and CapEx decreased 25%. BCE's financial targets for 2024 remain poor, with FCF expected to decrease a further 3 to 11%. Next is our one insurance company. Manulife Financial Corporation is 5.3% of our portfolio. Its KPIs all look great. And looking at its 5-year dividend growth of 9.9%, combined with its 5-year share price increase of 11% per year, this is making for a very strong dividend growth stock with total returns that are exceptional. It was stuck in a channel for a few years and has finally broken out. Our next position is Enbridge, representing 6.2% of our portfolio and is nearly a 5-digit holding. It reported Q2 earnings on August 2nd. Here's a quick snapshot. There was solid EBITDA and DCF growth. That supports its dividend for those that doubt in its very high yield, with DCF in the 60 to 70% range. Also, its outlook is looking solid, as you can see in this slide. This allows them to have $8 to $9 billion in annual investment capacity. Bravo, Enbridge. Next, we have our favorite telecom, TELUS Corporation. It represents 5.6% of our portfolio. BCE is more bond-like in our portfolio, whereas TELUS is more of the dividend growth holding. It is undervalued in my opinion. Q2 earnings on August 2nd proved that to me again. Don't get me wrong, they weren't great or even good, but they weren't as bad as many are expecting. For example, the total mobile and fixed customer growth was 332,000. Up 39,000 over last year, representing a record second quarter driven by strong demand in their leading portfolio of mobility and fixed services. We continue to add shares at these price levels. We added 7.3 shares at an average price of $21.77. That added $11.41 to our dividend income at a yield of 7.1%. Now take a look at Pembina Pipeline Corp. It is 6% of our portfolio. It released Q2 results on August 8th. Here are a few highlights. It reported quarterly earnings of $479 million, quarterly adjusted EBITDA of $1,091 million, and recorded quarterly adjusted cash flow from operating activities of $837 million. Also, Pembina has raised its adjusted EBITDA guidance to $4.2 billion to $4.35 billion. Before that, it was $4.05 billion to $4.3 billion. There's a lot of room to run here. Next is Capital Power Corp, an independent energy producer. It is now 16% of our portfolio and clearly our largest position. As a defensive dividend growth stock, it has really benefited from the lowering of interest rates in Canada. It is up 15% on the month and 27% since its April low. We built this out in full position from about Q4 of 2023 to Q2 of 2024. Next, we have another mid-cap stock. First National Financial is 8.2% of our portfolio. We've been nibbling at shares under $38 and will continue to do so. We are nearly at a full position size though. I think once mortgage activity picks up in Canada, we'll see more positive growth from the stock that matches its fundamentals. I anticipate a small special dividend at the end of the year. Next up is the darling of the portfolio, Brookfield Corporation. Represents 4% of our portfolio. It's up 68% since its October low when it was very undervalued. Brookfield Corp reported Q2 earnings on August 8th. My honest opinion is, meh. Distributable earnings from BAM were down on the year. Operating businesses were down on the year. The saving grace was the $850 million increase from disposition gains from principal investments. Something important to note for Brookfield Asset Management shareholders, BAM shareholders, during the quarter, Brookfield Corp's ownership in BAM decreased 2% to 73% as they used approximately $1 billion of BAM shares as part of the consideration for the acquisition of AEL. I still believe Brookfield has room to run in this bull market. Next, we have our smallest stock by capitalization, MCAN Financial. It represents 2.4% of our portfolio. MCAN reported Q2 on August 12th. MCAN continues to grow. Take a look at the financials last quarter and year to date. Everything is trending up despite the nasty Canadian real estate market. Year to date, taxable income is now up 12%. If this momentum picks up with the lowering of interest rates, we could be in store for another special dividend. Next up, we have another small cap stock, Fiera Capital Corp. It represents 2.6% of our portfolio. They reported Q2 earnings on August 7th. There really isn't anything exciting to mention. AUM is down $6.3 billion or 3.8% to $158.9 billion. I know I sound like a broken record, but I am looking for an opportunity to exit this position. Next, we have our other retail REIT, Smart Centers Real Estate Investment Trust. It makes up 6.2% of our portfolio. SmartCentres reported Q2 earnings on August 8th. Their KPIs are remaining quite stable. Also, as this slide shows, it is encouraging to see they still have the largest development pipeline, especially after RioCan has put on pause projects until the macro conditions improve, or so they say. It is also nice to see that SmartCentres debt will be maturing at a very appropriate time, with interest rates on the downtrend. Next up, another bank, TD Bank. It is 3% of our portfolio. TD is the second biggest diversified bank in Canada and the sixth biggest in all of North America, and have a 167-year continuous dividend streak going. They reported earnings on August 22nd, and the biggest item was their AML update. TD continues to actively pursue a global resolution of the civil and criminal investigations into its US AML program. In anticipation of a global resolution, TD has taken a further provision of $2.6 billion USD. TD expects that a global resolution will be finalized by calendar year end. Finally, guys, finally we can put an end to this. This should give some clarity to us shareholders and allow for the stock to return to its mean valuation. Next, we have another mid-cap, goeasy Ltd. It represents a measly 0.5% of our portfolio in the consumer finance industry. Q2 results on August 8th were again record-breaking. Loan portfolio up 29%, revenue up 25%, adjusted earnings up 25%. Man, I'm kicking myself for not going all in last year. And lastly, our one ETF is VFV, Vanguard's non-hedged S&P 500 index ETF. It is 0.2% of our portfolio. In the future, this will be changing to SPY or SPY. Do you want to guess why? SPY? Let me know what you think in the comments below. This is the third month running where we did a lot less buying. We deployed a total of $211.72. This added $14.74 to our annual dividend income at a yield of 7%. As a dividend growth investor that will soon be transitioning away from my secular work, I need to protect my portfolio from drawdowns. One of the main ways I protect my portfolio is by sector and industry diversification and weighting. Here's the breakdown of my portfolio by industry as of August 31st. Diversified banks make up 10% of our portfolio. Midstream oil and gas make up the largest at 19.8% of our portfolio. Regulated electric utilities make up 5% of our portfolio. Retail REITs make up 15.5% of our portfolio. Telecom services make up 9.7% of our portfolio. Life and health insurance makes up 5.1% of our portfolio. Independent power producers make up 16% of our portfolio. Asset management, 7.8%. Consumer finance, a massive 0.5% of our portfolio. Mortgage finance makes up 10.4% of our portfolio. And an S&P 500 ETF makes up 0.2% of our portfolio. And we know that S&P 500 ETF isn't an industry. So there you have it. There is our August portfolio update. Thank you so much for watching, guys, giving it a thumbs up, subscribing. A presto, a domani.